My name's Rob Field. I am a certified financial fiduciary at Nelson Financial Planning. Next to me is Chet Cowart, also a fellow certified financial fiduciary. Chet, good morning.
Good morning. How you doing?
I am doing well. We are deep into a 3-day weekend, which is quite nice. I'm not sure what all you've been doing, but I've been kind of hanging close to home. I've got my son and daughter-in-law are expecting a grandson that could be coming any day. So I have just sort of been keeping close, but getting a little pool time and enjoying the weather.
Yeah, me as well. Spending some time outside and looking forward to having Monday off. That's always nice.
True.
So
Now you got to go in the office tomorrow at all for anything, or can you really take a day off?
No, I'll be taking the day off. I'm gonna maybe go fishing a little bit, enjoy some of the nice weather. It's been really hot. I mean, I've noticed that now. Of course, every summer in Florida is hot, but it's funny. Every year I say, "Man, this feels like the hottest summer we've ever had," and every year it seems to get hotter. So, but I like it. I mean, most of the things I enjoy doing are outside, so the heat is not a problem for me.
Perfect. No, I'm right there with you. So let's just kind of delve in, talk about a few things. S&P 500. I think it's, the stocks that make up that S&P 500 in ratio to the other stocks, the proportion, not always the same, right?
Yeah. I think there is definitely a bit of a misunderstanding when it comes to owning that index. You hear all the time a big point of contention with investors nowadays is fees, and those index funds, things like SPY and VOO and the common ETFs that track the S&P are very cheap to own. They're static indexes, so they don't require a ton of management, right? So they're pretty cheap to own. But with that is concentration in a certain few companies that people don't necessarily know about. They think that owning the index is just a broadly diversified investment, which it once was, but it's not so much anymore, is it?
Right. That risk, is concentration, as you mentioned, because the S&P 500 holds roughly 500 companies, which kind of makes sense, which should be a broad index, a good indicator of a variety of things. But what we've seen lately is there's a large number of shares in a very select few stocks that are making up the majority of the growth, the portion, and the drive of that S&P 500. And so we've seen that the top 10 holdings now make up about 1/3 of the whole growth portion of that of that index. And so, technically you own access to hundreds of companies, but the results are really coming from just a handful of those companies.
Yeah, it's important to remember as an investor that these indexes or these index funds, and the index for that matter, is cap-weighted, market cap-weighted. So the bigger companies make up a bigger proportion of the index. It's not an equal weighted, but a divided by 500 ratio when it comes to your ownership in these companies. So you have to be careful, because it's easy to think that, I own the market, but that's not necessarily the case. Like Rob just mentioned, sometimes close to 40% of the index is the top 10 holdings. Oftentimes it's the Mag 7, that we've all heard about, and they're all concentrated in one single area of the economy of their one sector, essentially, which is information technology, AI, chip making, all of those things. So not only are you concentrated in 10 companies, it would be better if those 10 companies are in different sectors, but that's not even the case. So you're in 10 companies, but you're also in 10 companies in the same sector. There's a lot of risk there. So, and a lot of risk that people don't necessarily appreciate, because everybody just thinks that they own the market.
Right. As you mentioned, that is exactly what it is. You would think 500 companies, you would own a good broad index of a variety of different companies, but in practice, you're really kind of narrowing it down and not really getting diversification that you would like. All it takes is a couple of earnings misses, a bad report, something related to AI that really spooks a small number of companies, and the whole S&P 500 dramatically changes.
No, and it's hard to argue this right now, because the index, the S&P in particular, performs so well, or it has been lately, due to these 10 companies performing well over a decently long period of time now. But I think what you have to remember is what's most important is not so much total return, but risk-adjusted return. because your risk-adjusted return in something like a VU or SPY or any S&P 500 index is actually not great if you think about it, because your risk is tremendous. You really, it's almost no different in just buying those 10 companies in single stocks and holding them in a portfolio. I mean, you do in an index have a little bit more than that, of course, but like we said, with almost 40% concentration in those top 10 companies, you're not getting the diversification that you probably think you are.
Right. You could think of it this way. If one stock were to represent 7 or 8% of the index, and then you had a few others that also carried a pretty large amount or a pretty large weight, that index is really no longer giving you an even exposure to the market. It's very concentrated in just some very small pieces. So, the performance of a broad market fund, a mutual fund that's truly more diversified, it's not going to always resemble what you see on the S&P. And that throws people for a loop when they're trying to compare S&P to a mutual fund that's a little more diversified. It's not apples and apples. So you kind of get this narrower mega cap type look, but you're not really getting what the S&P was designed to do years back.
Yeah, no, I mean, the principal idea of diversification is sort of becoming lost in these indexes, and it has been that way for a couple of years now, really since COVID is when it truly blew up and the market ran up and the indexes, became a little bit inflated in that way. That's why for our clients, we tend to gear more towards these actively managed, well-diversified mutual funds that tend to perform, for example, if you have a mutual fund that performs maybe 1% worse than the index over time, but your risk-adjusted return is infinitely better, then that's a much better investment for you on a risk-adjusted basis than something like an S&P index.
Right. An example might be, if someone were to own, an S&P 500 index fund in their 401k, then they also, let's say, had a large cap growth fund in just a straight mutual fund. Then maybe they also had a tech-heavy ETF, exchange-traded fund on top of that. On paper, that probably seems like a pretty well-diversified investment amongst multiple funds. But the truth is you probably stacked very similar companies over and over and over, and again, heavy-duty concentration.
Yeah, no, some of the overlap can be a serious concern, and especially, some of our software like Morningstar, which we run clients' portfolios through, especially clients that have outside portfolios, we often see that while they maybe have 10 or 15 different positions, they really own the same 20 companies over and over and over and over again. So they're not as diversified as they think, versus our clients who will have 10 or 15 different seriously diversified mutual funds. They may own 1,500 companies all over the world, not just domestically, and they're going to their risk in terms of one company succeeding or failing is significantly less than someone that's a index-only investor, for example.
Right. Going with that diversification, we're not saying that some of the companies in the S&P 500 need to be abandoned. You just don't want to be loaded up too heavy in one certain area. We'll be back after this message. We appreciate you listening to Dollars and Cents.
Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida. We're also one of the top 25 financial planning podcasts on the World Wide Web with over 50,000 downloads. We're popular, aren't we?
Yeah, and it's amazing. The number of programs we've put out, because you can go back and catch any podcast, any show we've done over the last quite few years. And as we bring up a subject, people are like, oh, I want to hear more about that. And they'll catch that day's show and then go back and do more research. And then the word spreads.
50,000 people want to hear me and you talk. Isn't that exciting?
That's, I got 2 kids. Neither one of them really want to hear me talk. So
nobody wants to hear me talk. So I love coming here.
Yeah, exactly. Nobody can interrupt us.
Yeah, I get it.
I want to hear you talk, so I'm not going to interrupt you. Yeah, perfect.
Well, my name is Chet Cowart, certified financial fiduciary here at Nelson Financial Planning, joined by Rob Field, also a certified financial fiduciary at Nelson Financial Planning. Before the break, we were talking about some of the dangers of investing in the S&P 500 index nowadays, namely concentration of some of the top 10 companies within that index. So we're going to hit some of the key takeaways from that. We have plenty more to talk about. But yeah, there's certainly a danger there when it comes to investing in these static indexes, especially now considering what has happened as due to the cap weighted nature of the indexes. These top companies within them have become so inflated.
Exactly. We're basically just trying to remind people that, if you're comparing apples and apples, the S&P 500 index and then a truly diversified mutual fund or portfolio made up of companies inside of that you might find in the S&P 500, it's not always the same. A mutual fund company is going to try to truly keep you diversified, so performance may be slightly different. So just always make sure you're comparing apples and apples. If you have more questions on that and kind of want to talk about your portfolio compared to the S&P, certainly give us a call and we'll go into more detail. Why don't we just talk about some of the things that we thought were important about that S&P 500. First of all, S&P 500, it's still a broad, diversified portfolio by name, 500 different companies.
Right.
But right now, we're currently seeing a larger concentration in certain companies that have grown faster or have been kind of on the AI bandwagon, and it's given this concentration that's affected performance of what we would normally see in an S&P 500.
Yeah, no, absolutely, and they're very, very popular right now due mainly to the performance. I mean, we can't sit here and say that they haven't performed well. They certainly have, but there's a danger lurking in the background because, as you said in the last segment, all it takes is a couple of companies to have a couple of bad earnings reports, and it could all come crashing down just due to the fact that it is 7 to 10 companies that are really, really driving the index. And beyond that, the small group of mega cap companies that drive the index are part of the same sector for the most part. So, think companies Apple, Meta, Google. These are all information technology companies. NVIDIA, of course, is a big one. They make chips. And these are all part of the same industry, the same sector. That adds another layer of danger just beyond the concentration of them.
Right. And we also were pointing out that you might have multiple investments, multiple mutual funds, and then you're thinking, okay, that gets me a pretty good diversification. But a lot of times there's a crossover. You'll find similar companies, similar stocks from companies in multiple portfolios. So you're not always as diversified as you would think. Each portfolio, if it's designed for some type of growth, they're looking for the companies that are going to provide the growth. So
right.
just be aware of how concentrated your own personal portfolio might be.
Yep, absolutely. And one thing that we do for our own clients to help remedy this is just consistent and often rebalancing, right? So multiple times a year throughout our client meetings, but also our summer call-out program, we rebalance client accounts so that you are not too concentrated in one sector or another. And that's very important because different sectors perform well at different times. For example, last couple of years, software companies have done very well, and then earlier on this year, software companies were not doing well. So you don't want to be in one single sector in any investment, and we make sure to rebalance often to make sure that's not an issue for our clients.
Right. We also remind people don't turn your back on larger blue chip companies, dividend paying companies. They are a staple investment that you should have from time to time. Don't get sucked into the top 5, top 7 companies that are always in the news and trying to build up your portfolio just around those. Also, you want to take a look at your fund holdings. Make sure that you're not getting over anxious in trying to follow or track companies that are hot right now. Make sure that all the investment decisions you make when you build your portfolio are based on your long-term needs, your risk tolerance, your income needs, and then your specific time horizon.
Absolutely. So with that, we're going to dive into our next little topic here, and it's going to be some behaviors that hurt retirees and what to do instead. So you want to start us off?
Yeah, what we're thinking here is that, as people hit into retirement, things are going to change. And sometimes your thinking changes, and sometimes you're making decisions that aren't really accurate for being actually in a retirement mode. So, we looked at 7, what we call the behaviors that hurt retirees. And so, the first one we were looking at was talking a little bit about cash. Mm-hmm. And so we wanted to kind of talk a little bit about that. But we did want to make sure that people knew that, a bad decision overall can really have a long-term effect on your portfolio. We've seen people make decisions, snap, a quick knee-jerk reaction, and it's cost them a couple % every year. That multiplies out.
Absolutely. Yeah, and holding too much cash can be a delicate balancing act in retirement, right? Because you do want a portion of cash and bonds in your account, especially as you get older. The key consideration here, I think, is that your portfolio needs to generate income for you in retirement as your work income goes away. And to be able to sustain that income, you need to find the balance of cash to stocks in order to be able to sustain your income. It's great to have cash and be safe, especially as you get older, but that doesn't tell the whole story, right? If you have all cash, then your income is just going to drain your account.
Right. As you mentioned, cash feels safe. Obviously, cash has very little volatility. There's a comfort zone to that. But you then take a problem, or you create a problem of inflation, because cash typically is not giving you the returns you might see in a more diversified portfolio. So as you head into retirement, if you're making a decision to go heavy into cash, you're going to have trouble keeping up with inflation. You're going to have an erosion of your purchasing power.
Yeah, I think the way for our clients that we look at the cash and bond balance, and if you're a client of ours, you've heard us say this in meetings multiple times, how much cash do you need? Well, if you're taking income, which most retirees are off of their portfolios, will bank maybe 3 to 5 years of income and leave that in cash and bonds, leave that out of the market. So then the way we see it is that if the market were to have a turnaround, it's likely not going to last 5 years. So we bank 5 years of income for you, so that if that were to happen, worst case scenario, then you always have a place to pull your income from that does not come from a position that is down and reduced in value.
Good point. The next mistake that we see that happens a lot of times is taxes and people not really keeping up with that piece of the portfolio. So, we talked about spending, and then we talked a little bit about, what the taxation can be on it. You just want to keep that in mind. Mm-hmm. Another thing a mistake we see a lot is when people are trying to time the market with their investments.
Mm-hmm. No, absolutely. And this is a big behavior. This is entirely human nature and entirely behavioral. I see this personally all the time on phone calls and in meetings with clients. It's, when the market goes down, they want to move to cash and then wait until a quote unquote good time, right, to get back in. And then when the market is shot back up and all of the funds are doing extremely well, they want to move back into the market. And emotionally, you can completely understand where that thought process comes from. But that, of course, is the exact opposite of what you want to do. You're buying low, or you're buying high, and selling low. And that's, not the mantra you want to follow necessarily.
Right. We've seen data, and it shows that if you miss like the 10 best days every year in the market, and that's what happens a lot of times when your timing is like, you're like, well, I'm in, I'm out. We've seen it numerous times when the market starts to come down, people get nervous, they get out. And then by the time the market starts coming back up and they're comfortable, they've missed a lot of the growth. So if you miss that, it can really, over multiple years, knock down your average total return 4 or 5%.
Significantly, yep. Well, this is Dollars and Cents with Chet Cowart and Rob Field of Nelson Financial Planning. We'll be right back after the break. Welcome back to Dollars and Cents. We help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program. I'm very excited to say that because it's been going longer than I've been alive.
I didn't think of it that way, but that is an accurate statement.
Yeah. So we're doing something right. I can't take credit for all of it, but the last couple of years it's been great. So in the last segment, we were talking about some mistakes that retirees make when it comes to their money. We're going to continue on with that. I'm Chet Cowart, certified financial fiduciary at Nelson Financial Planning, joined by Rob Field, fellow certified financial fiduciary here at Nelson Financial Planning. So we ended off on timing the market. That's a big mistake that not only retirees but many investors make. So now we are going to get into some of the tax mistakes that people can make, and just tax considerations that people aren't necessarily making when it comes to orders of withdrawals and that sort of thing.
Right. Just always want to keep in mind the difference between a taxable account, a traditional IRA, and a Roth IRA. They all can kick out income. They can all kick out the same amount, but the taxation of it is different. And you just want to kind of keep that in mind, what sequence. They do behave a little differently, so just be aware of that as you make your tax planning on the income you're generating from the portfolio. Mm-hmm.
Yeah, no, absolutely. Every account is going to have a different tax nature, of course, right? So you have brokerage accounts that are going to pay or you're going to owe taxes on the gains. And then you have pre-tax retirement accounts like a traditional IRA, where every dollar that comes out is income. You have Roth IRAs, which are tax-free. So there's going to be, considerations to make, especially when it comes to types of withdrawals. You need to meet your RMD, but you also need to be careful not to trigger IRMA and Medicare premium, surcharges. So there's a ton to think about with that, and we of course help our clients through all of those decisions as well.
Good points. So the next mistake that we sometimes see retirees make as they are entering into retirement is chasing yield. Yield is attractive. It seems simple. But it's an area that sometimes gives people becomes a stumbling block.
Mm-hmm. Because oftentimes money market yields, for example, are going to be some of the lowest, right? But that's also the safest. You can get into the whole junk bond conversation, chase super high yields, but with that comes default risk. I mean, there's a reason, just by the order of risk versus reward. There's a reason why there are some fixed income instruments paying 10%. It's not necessarily, the reason is because they're probably not going to pay you that 10% over the length of the term.
Correct. I mean, if you think higher yield, it doesn't necessarily, mean better. Sometimes higher yield often means higher risk, because you've got to get a lower rated bond to get the higher yield, which creates more underlying fluctuation of that bond's value.
Right.
So, you have to think about credit risk. That's what determines how the bond might be rated. Interest rate risk. I mean, depending on what the yield is on your current bond or money market, and if you've locked it in, especially like a CD, and rates change, could have a negative effect. And then also, as we talked about, the same thing on the S&P 500, concentration risk. If you're all in one type of CD, one money market, one type of bond, it doesn't keep you diversified. So just be careful if you're going to dabble with things that generate yield.
Yeah, and then what you said there, I think, is important, that not a lot of people think about when it comes to fixed income investing, is that there's a secondary market for these things where they are bought and sold. You have to think about your liquidity, right? Because if you find a fixed income investment that is maybe yielding 10%, that's fine if one, the company actually pays and doesn't default, but also if it's your liquidity is important. If you plan to hold it to the end of the loan, then that's not something you really have to think about. But if you want to sell it prior to then, it's going to fluctuate a lot on the secondary market. And if your fixed income investment drops 20%, that's not necessarily stable income, even though it's paying the yield on a yearly basis. You still have to think about your principal.
Right. We think about parity. We see that a lot where somebody owns a bond and then they want to sell it. The price of that bond is going to go up or down based on what the current rates out there are. So if you bought it with a lower interest rate and then rates go up, and now you want to sell it, you got to drop the price so that the yield comes up to be competitive. So now you had a low yielding bond or bond fund, and you are now looking at a decrease in the value just to make it competitive.
And they trade like stocks as well in terms of supply and demand. I mean, just high in demand bonds and low in demand bonds will fluctuate in value as well. It's not as simple as just a money market or CD would lead you to believe. Those investments in particular are relatively simple, but the whole bond market is not uncomplicated. That's for sure.
Correct. You got to think total return, not just yield. You got to think about the whole package of anything related to a bond.
Absolutely. So next consideration is rebalancing. We touched on this when we were talking about the S&P 500 in the first and second segment, and concentration risk and that sort of thing. But this goes for any investor in any stage of life, but really particularly in retirement, rebalancing is very important.
Right, portfolios will drift. They can go up and down in the actual ratio of stocks and bonds. If we are in something like we've seen the last couple of years, where the stock market is definitely outperforming the bond market in total return, that means that the percent of stocks is going up versus a percent of bonds or bond or cash related could be going down. So whether you make a change or not, your portfolio is going to change in the allocation.
Yeah, no, I mean, over time, stocks are going to outperform bonds. That's just kind of the nature of the beast. And if you start out at, let's say, an 80-20 or a 60-40 mix, or however you want to shake it, over time, that stock piece is going to grow disproportionately to the bond piece. So it's important to rebalance often.
Right. So the simple fix is, is the rebalance, be aware that the allocations are going to change, and then don't be influenced by what the market's doing currently. Always kind of go back to that original allocation that you knew was best for you and rebalance to get back to that point.
Yeah, absolutely. Next one, overreacting to news. This is a favorite of mine because I see this all the time, and I can think of so many examples in just very recent history where if you had overreacted to news, it really would have hurt your account. The most recent one in my mind is the tariffs. The tariff situation. This was about a year ago in 2025. The market dropped relatively significantly in a very short period of time. And if you had overreacted and, let's say, moved your balance to cash in one swift move due to fear and whatever reason it may have been, you would have missed out on the amazing year that we had for the rest of 2025, but also the run-up like 2 weeks later that happened right after the news. So you really have to be careful to not overreact to news. You have to trust that your allocation and that your portfolio is a good one, and it's a good one in any market situation, and it's one that can outlast any news that may come up.
Right. You make a good point with the tariffs. We noticed last year the news was strong and on the negative side about what the tariffs were going to do and the market was going to drop, and they just pounded investors with that information, and investors listened, and a lot of them, unfortunately, bought into it and said, you know what, this news is scaring me. I'm going to get out of the market and just wait for this to subside, and then somewhere down the road, I'm going to get back in. But the news never comes back and says, okay, it was a very short-term issue. Yep. Tariffs have been suspended for a period of time, so now you need to go out and get back in the market. We never get that news.
Right.
And so that's why it's hard to time the market. It's also hard not to listen to the news, but if you step back a little bit and say, okay, I'm talking to somebody about building my portfolio for the long term. Yep. I want something that'll survive the long term. I want a portfolio that's designed for me, that'll take me through the ups and the downs. That's where people have success.
Yeah. No, I mean, we build our portfolios for clients to be effective in any market situation. That's not to say that we don't rebalance, right? We just went over that. Of course we rebalance, but we don't make rash decisions due to what the market is doing at any given time. We don't try to time the market. I mean, you can think even back to COVID. That's maybe a more there was a lot more going on during COVID than there was during the tariff situation. But even then, the market dropped significantly. And then within a month period, we were right back and higher and breaking all-time highs. You really need to be careful not to overreact to the news, because oftentimes long-term it's inconsequential.
Right, which is a great point. But it also reminds us of the next issue that some people kind of a mistake they have is adjusting over time. So certainly, we're not looking for people to make a reaction every week and change it. But as your portfolio changes, as you age, you do want to take a bigger look and make sure that you're still designing that portfolio to meet your longer term needs. We'll be back in a moment. You're listening to Dollars and Cents out of Central Florida. We wanted to take a little time during this segment and talk about retirement, and are you actually ready? Have you thought about certain things? And then we're going to name a couple of ideas that if you're still involved in these areas, you might not quite be ready for retirement. So let's just jump right in. First thing we wanted to say was there is an article and it has these warning signs, and we're going to share those with you. So the first one that we wanted to kind of share with people, if you're still struggling with your expenses and you're thinking about going into retirement, it's probably not a good matchup.
Yeah. I mean, cash flow is going to be the most important thing to manage when it comes to retirement, right? Because if you're having trouble managing cash flow while you have work income, that's probably going to continue to be a problem in retirement. Sometimes we do see people retire with more monthly income than they had in their working years, but oftentimes that's not the case. So if you have trouble making your payments, meeting your expenses before you retire, it's probably not time to retire yet.
Right, because when you go into retirement, you're going to have an increase in some of your expenses. You're going to find out that, travel, you're probably traveling more, you got more time. Yep. Healthcare costs go up dramatically, way faster than we can keep up with, way faster than inflation. And leisure costs are going to go up. The number of people who say, I'm not really going to do much different in retirement, so I don't need a lot of income, except that I'm buying this boat and I wanted to get an RV. We're finally going to take a trip to Europe. My wife always wanted to have the kitchen redone. It's like, well, that's a list of some heavy duty expenses that might not be as easy to finance during retirement.
Yeah, I think what's often forgotten is that what's forgotten is how much money you save by virtue of spending 9 hours a day in an office or at work. You don't have time to spend a lot of money. Now you're in retirement and you have all day to spend money. In fact, that's really all you can do, because you need to fill up with your day with things that you enjoy. Boats are great. I love boats as well, but they are expensive, and you need to just make sure that you are in sound financial shape before you make that jump.
Right. So, I mean, the key takeaway there is, if you can't comfortably take care of your expenses today, don't think it's going to get easier when you get off into retirement.
Yeah. And the next up we have, this sort of piggybacks on that same idea, but if you still have a mortgage, now there's a caveat here. If you're one of those lucky people with a 2.5% mortgage, and you can truly make the argument that your money is better invested than paying off that mortgage, then that may be a different story. This is all, kind of client dependent, person dependent. But with that being said, still having a mortgage is a big expense, and that's something that that would be valuable to get out of the way before retirement.
Sure, because, every dollar you spend towards your mortgage is $1 or so that you're not going to be able to spend towards the fun things you're hoping to do, or the flexibility, or the healthcare costs. And your living expenses, you can't get past it. You got to live someplace. And if your mortgage is paid off, you can just wipe that off completely. Even if you just said, well, I'm just going to rent. Rent costs are extremely high too, so that doesn't really help you out.
Oftentimes more than a mortgage, and a mortgage payment is a significant enough of a payment that could be maybe one of the reasons why. So, for example, we always talk about the 4% rule. Right. This is the safe withdrawal rate, so to speak, that you can pull out of your accounts and maintain your balance as well as allow it to grow over time. A mortgage is a big enough of an expense to where that could be the one that pushes you over that 4%, maybe up to 6, 7, and that can really hurt your return over time. So just things to think about. Mortgage might be something that is worthwhile to get rid of before retirement.
I've seen a variety of mortgage payments that were higher than what somebody was getting with their Social Security monthly payment.
Yeah, absolutely.
And so, if your Social Security is completely wiped out by just the mortgage,
right,
and you still got to put food on the plate and do all these different things, your budget can get really tight,
especially
when you get into
if
retirement.
You retire before 65 and you're having to pay health insurance out of pocket. That's a huge expense as well. And that kind of gets us into our next topic, which is underestimating healthcare costs.
Sure. So, people do underestimate their healthcare costs because it doesn't seem like it's going to be that expensive. But even on Medicare, you got a monthly out-of-pocket if your income's a certain level, and then you've got the income-related monthly adjustment amount surcharge. Boom, you're on your way up. Sometimes even the best of plans still have co-pays or only an 80-20 coverage. So, a lot of people assume that healthcare will get lower cost in retirement because they're not having to pay all the large amounts they paid through work, but it's not necessarily going to drop as much as you think.
Yeah, no, Medicare is not free. Even when you're 65 plus and you're on Medicare, it still costs money, and the cost can be significant, especially if you're pulling out a ton of money from your retirement accounts for a mortgage or for a boat or an RV or whatever it may be. It can certainly be a significant expense, and people are living longer as well. So there's more considerations to make there when it comes to not only withdrawal rate, but then what your long-term projections for healthcare costs are going to be. Because oftentimes, maybe when you first retire at 65 and you're traveling and you're still active, your costs might not be all that significant. But when you're 85, 90, it might be quite a bit more, especially if you think about long-term care and that sort of thing.
Very good point. That's a great point. Another sign that you might not be ready to go into retirement full-time is if you're still supporting your adult children. We see this more and more where, kids getting out of school and they're having trouble getting a job, or families change and they decide that the family's going to come live with you. If you're supporting them, you got to be really careful about what that does to your budget.
Yeah. And people are doing more and more for their kids nowadays, not only, supporting them on a monthly basis with certain expenses, but also helping them buy houses and that sort of thing. That's a huge expense, of course. If you're helping with a down payment, that could be $50,000 or more. Even if you're just putting half of it down, it could be $50,000 or more. So, there's big expenses with adult children. That one, I guess, is optional because you don't have to do it, but oftentimes people are doing it. So it's something to think about.
Well, like you mentioned, it's optional, but certainly something to think about. If you're kind of toying with the idea of retirement, keep in mind that to keep your expenses at a certain level, supporting other people in the household can throw a monkey wrench into the total program. So it's understandable. It's great. I admire people who want to help out their kids. But, when you do that, you're essentially taking money away from yourself and your health care and how you're going to live. So be careful you're not sacrificing to help others, and then it gives you a lot of unhappiness or unpleasantness.
There's a difference between helping and enabling. So set your boundaries with your family if you can.
No, that's a great point. That's a great point. The next item that we think is important as you're deciding if you're going to go into retirement is you need to have an emergency fund. If you haven't got money set aside for an emergency and you're not working and then something happens, you just might not be prepared.
Yep. No, absolutely. Emergency fund is important. And not only for emergencies, but it helps you make a more tax-efficient decision when it comes to your withdrawals. So, for example, we have many clients with IRAs, of course, but they also have large money market balances on an after-tax basis. And what that does is they can maybe take their monthly income from their retirement accounts. That's going to be taxed the same way that their W-2 income was their whole life. And then beyond that, let's say they need to buy a car or they need a new roof or they're retiling their floors or whatever. If it's a big expense, that's something that we would advocate pulling out of an after-tax account, a money market, things like that, so that you don't kick up your taxable income, you don't run into IRMA issues, you don't jump up a tax bracket. Lots to think about there, but it's good, again, to have multiple buckets that you can, multiple buckets of assets that you can pull money from.
Right, it's important on that emergency fund that's money set aside separate from your investments, that you're not planning on, if I have an emergency, I'll just make a withdrawal from one of my investment accounts, because if the market goes against you in a short period of time and then you're taking out income and then you got to go in and do something for an emergency, you've really hit that portfolio hard. And then so when we sit there and think in terms of, I am going to, plan some other expenses, there's just not enough room in the portfolio to also cover the emergencies.
Absolutely. Well, thank you guys for listening. This has been Dollars and Cents with Rob Field and Chet Cowart of Nelson Financial Planning. Hope you enjoyed, and we will see you guys next week.